Is Thursday, May 15th. And I am an associate member of T3 Trading Group, which is an SEC registered broker dealer and member of FINRA SIPC. All of my trades, they're all placed through T3 Trading Group, and you should carefully consider whether trading is suitable for you in light of your own financial condition. My position disclosure is the same as it was yesterday, with lots of buy and sell buttons pressed in between throughout the session today. All right, let's jump on into it. So, market closed, you guessed it, green. Spies here closed up about 0.5%. The Qs closed up 0.1%, maybe a little bit more than that. The IWM closed up 0.75%. The Russell kind of resumed some relative strength to the Qs at some points throughout the trading session today, and definitely into the close. In the afternoon, the Qs are rolling down a little bit. The IWM never downticked at all. What did bonds do? Bonds closed green, so some real relief there. TLT below $85, I think, was about to become a real concern. That TLT 85 has become very big support. It was held again today. The dollar, which has also been important recently, finished down. Quick look at gold, green, IBIT. every time in the afternoon meeting I type up this IBIT, I don't get a quote right away. There it is. Down 0.25%, and oil was down today. All right, so it's our quick snapshot today. These afternoon meetings are getting a little bit tired because I just say the same thing every day, because the same theme is ongoing every day. The relentless, never-ending bid continues to be relentless, and it continues to be never-ending until eventually, at some point, it will slow down. Eventually, at some point, it will end. Whether that happens here at SPY 390 or that happens at SPY 750, I have absolutely no idea. Berkshire Hathaway boosts positions in STZ, VRSN, Pool, DPZ in Q1 per the 13F. Thank you, Bill. Yeah, we're getting 13Fs today, so those are slowly piling out, moving markets a little bit. Yeah, I mean, this market is just incredible. It really, really is incredible. These last 2 months have been historic. If you're a new trader, this is not normal. April is not normal. May is not normal. This is not normal. This is not how markets tend to trade. This is not how up movements tend to trade. The way that up markets tend to trade is, I don't know, let's just scroll back to the rally in the second half of 2024, where it would grind up and give a little technical pullback, and it would grind up and it would give a technical pullback. But here's a little bit of accelerate. Oh, this was the election. But even with the election, really big move that extended us, technical pullback, grind higher, et cetera, et cetera, et cetera. This is just how markets trade. I mean, sometimes you get faster down moves because fear is a stronger emotion than greed, generally speaking. So seeing a fast down move isn't that unusual. Seeing a fast down move with what we saw in April, where that move was bigger and faster and harder than anything we've seen since the financial crisis, is extreme even for a fear-driven down move. But yeah, I mean, this is not normal. This is just not how markets tend to trade. So at some point, I would assume at some point we return to a degree of normalcy. But this is crazy. I mean, it's the positioning bid. That's really what this continues to be. There's not really anything new that's ongoing. Really not really too much news since Monday. I know that there's been some news out of Saudi Arabia on some investments. I think that most of that was pretty well foreshadowed. Maybe not the degree that's been promised. But for the most part, today especially, and I guess yesterday, nothing new. This degree of extension typically requires some degree of correction in order to give continuation, yet we do not correct. Yesterday was a little bit of a rest day. I remember in yesterday's afternoon meeting we were talking about, wow, we're going to get an inside and down or an inside and up. An inside and down to give us some price correction feels normal, but an inside and up wouldn't shock me just because that'd be a momentum move, and this market is insane because the underlying bid is insane. The systematics continue to buy, but it's more than just the systematics this week. I think that this week is really the first week of a lot of fund managers saying, oh man, we are really off sides, and they're grabbing into upside, a lot of forced buying. I think that we saw in one of the notes, I don't remember if it was in Pat's note this morning specifically or not, that a lot of this has been led by short covering this week. So it just shows you that it's just a lot of people being off sides. Trying to remember if that was in here on that Goldman note. Short covering continued, but less pronounced in magnitude versus earlier in the week. So that's just an extra piece of information, I guess, on top of a note that I read somewhere else that showed that there's just been a lot of short covering that's been going on this week. So it's forced buy-ins, it's forced short covering, it's continuation of the systematic bid, it's negative gamma on the upside that's pushing us higher, and it is really strong. That's pretty much it. I do think that I've been saying this for the last couple of days as well, like a broken record. I do think that we're starting to get closer to the point where the systematic bid slows down somewhat dramatically, actually. Doesn't go away. It's not going away, but slows down. I don't have that Goldman note in front of me anywhere on the CTA numbers, but if you look at was it in I don't remember. But if you look at like the CTA numbers that Goldman gave us, if you look at like the 1 week buying versus the 1 month buying, what you see in them is basically like half of the 1 month buying in a flatter up market is this week. So again, think about what I just said. I wish I had the visual to throw up in front of us, but about half, going from memory, of the 1 month buying from CTAs happens this week, right? So I think that number was somewhere around $14 billion of buying from CTAs into a flatter up market for this week. So that would mean that and again, I'm going completely off memory here, that would be the 1 month number is like 28. So when you get through this week, that number drops down in a flatter up market to like 14, but that 14 then gets spread out over the course of the rest of the month, which is 3 weeks. So like the buying that's coming from CTAs in this week will be the equivalent of the buying that we see in CTAs over the course of the next 3 weeks. And that's assuming a flat or a up tape. I think after this week, the rest of the month on CTAs, it actually goes into selling into a down tape. So the positioning risk after this week from a systematic perspective would still be to the upside, but significantly less, and you actually can get a down move, right? Into a down market, you don't have that same bid. Obviously, that's just one cohort. That's just CTAs. There's also Vault Control, which is still under-owned at this point, but the amount of buying is also being a little bit reduced because of the juxtaposition between the 1 month and 3 month realized vol lookbacks. I think that there's also some strong buying that can still come in from risk parity as well. They're under positioned compared to where they normally would be. The corporate buybacks are obviously still ongoing as well. All of this is contributing to this seemingly forced bid to the upside. I really feel like this week is a positioning squeeze, more so than like a real movement. And I really think that when we get through the positioning squeeze, I think if the market stops going up, or if it does go up, it goes up in more of a grind fashion. I do not think that the rate of movement to the upside that we have seen this week can last for very much longer at all. This also coincides with OPEX tomorrow, which is another big one. And I also feel like some degree of the price action that we saw yesterday and today was actually already related to some degree of a pinning effect into that OPEX. So we'll lose that we'll be losing that as well as we get to this week. So maybe next week when we lose a little bit of the bid from the systematics and a little bit of the pinning effect that might already be coming in from OPEX, we can open up the door for this market to potentially correct through time or price. Maybe, sorta, maybe. But that's kind of where my head's at. I do think that at a minimum, this market starts to go sideways for a little while, even more of a bull scenario, and then we'll see what sort of economic numbers come out. Really more when we get into June. But that circles back in my head now, actually, to what we saw with the Walmart report this morning, which I thought was particularly interesting, just on what they said about the timing of their price increases. The timing of their price increases probably won't happen until the end of May, which I just thought that was interesting because I've been saying every day that we probably won't see the impact of tariffs in the economic numbers and inflation reports until the May numbers come out in June. But if Walmart is similar to other companies, and I don't know that it is, if it is, then it really might not be until more like July that you see those numbers. And who knows what other trade deals and everything else is going to happen by then. You know, it does seem like these companies did a great job preparing in advance for these tariffs to hit as much as possible. So yeah, I mean that's the market. You know, the intraday, this market just continues to crush. We had some weakness in the beginning of the day, but even into that weakness, like there's been a few occasions where I feel like there are sellers that are out there that are unable to drive the market down because they're running into this bid, but they're present enough to at least not let the market move up. And then seemingly around the time when Europe closed today, maybe the sellers roll Europeans or something, the selling just stopped. The bid was still there, and we went higher and basically stayed higher for the S&P for the rest of the day. The Qs was interesting how it gave us a little bit of an afternoon rollover, but you know, I don't want to overread that. So I mean, yeah, that's pretty much all that I got. On my end, it was a little bit of a slower day. You know, the beginning of the day and pre-market, I used as an opportunity to be able to cover some of the shorts that I have on, reduce a little bit of exposure. I did add back that exposure into the up move, but I, you know, yesterday and today have taken a little bit of my shorts off. Not because I want to, but because my rules say that I have to. I have been taking a little bit of my shorts off and reducing some exposure at a loss on some of those positions, just for risk management purposes. Even though in the back of my head I feel confident it's going to be one of those situations where it's like I take it off a little bit as a loss, I size down a little bit as a loss, and then it's just because you know my approach couldn't be patient enough to get through this never-ending bid to actually get the pullback, which then means when I get the pullback that, you know, I won't make as much from it. But I am confident that we will get some degree of correction soon. It could happen as early as tomorrow. You know, it was a very, very different situation from the systematics, but that OPEX day in February, the Friday was the day that we actually really started to sell. But again, it was just a very different market dynamic at that point, and that's what enabled us to call the top in February. Was I was saying like, yeah, I know we just made all-time highs here on that Wednesday, but there's no one left to buy. Everyone is in the pool, and this situation now has been the opposite. It's been no one's in the pool, and everyone is diving in head first because I don't know where I'm going with this analogy. The temperature got too hot or something, and everyone is rushing in as fast as they possibly can. And not everyone's in the pool yet, right? We're the buying that we've seen, the positioning that we've seen over the positioning squeeze we've seen over the course of these last 3 weeks. All it's really done is given us some degree of a return to normalcy as far as the positioning goes. It is not a situation where, like we were in February, where it just seemed impending to me that a market could really feed on itself on the downside just because of the systematic selling that would be forced to come in. This environment now, it's like I'm not expecting that we can roll down and have that get fed into by a huge degree of systematic selling. It's more a matter of they're not buying in the same way, which allows market participants themselves, more discretionary participants, to take a little more control of this market, because I don't think that discretionary participants have had any control of this market these last few weeks. It's just been getting bought up and bought up and bought up from the systematics. So yeah, that's all I got. I have to be done by 5 at the latest today, 5 Eastern at the latest today, but it gives me plenty of time, I think, for any questions that you guys might have. So happy to answer them. Looking in the VTF here. From Richard, why is it 3 weeks, first week of June included? No, so it's just, I think it's just from the time in which the note was posted, which I think was yesterday, where it gives me, it's an estimate, right, based on models that Goldman has on what they see over the course of the next 1 week and 1 month, I think from the date in which it's published. So I think it's just from the date in which it's published. So, if you assume that a month is 4 weeks, give or take a couple days, then you know what the 1 week numbers are, you know what the 1 month numbers are, well, then you know what the numbers are for the second 3 weeks of the month after you get through the first week, right? Just some basic math. From Tate, we're all waiting on hard data in June from May, but with time on our side, I think there's a real chance the May numbers could end up being a one-off. If there are better deals in June and nothing is set in stone yet, it's possible the data won't reflect a lasting trend. I agree with this statement 100%. It's not an argument I've heard anywhere else, but 2 weeks ago, no one expected us to be trading at these levels, so you never know. No, I have heard that argument, actually, and it makes 100% sense. We what we're doing right now from a policy perspective is so unique that we don't really know the lasting effects on it. There is a possibility that inflation from tariffs is just like a one-off thing, where we see a quick spike in inflation because prices of every good that gets imported, or every good that now has to be made in the United States because it's not being imported, which therefore means it's going to be more expensive, goes up. But it's not like lasting month-over-month inflation that feeds on itself. That's definitely one theory out there. And that also would mean that the bigger risk is more on the growth side than on the inflation side. But that's all, to be determined, I think. So we'll see how it plays out. So yeah, that's definitely something that I've heard. There's a good chance that we just see some like real kind of crazy one-off economic numbers here and there over the course of the next few months that is just a result of what's happened. So we'll see. From Richard, quick question. Next Friday and Monday after that, is the market open during Memorial Day? The market should be closed on Memorial Day, but open on the Friday. So it'll be open on the Friday, but closed on the Monday. And then we're also closed on, I think we're still closed on June 19th, right? We didn't get rid of that holiday yet, did we? And then 4th of July, the market's closed also. So that's it. There's a rule where the stock market, it's an antiquated rule. I wish they would get rid of it. There's a rule for the U.S. stock market where it cannot be closed for more than 3 days at a time. So that's why you get like the half day after Thanksgiving. So Thanksgiving is always on a Thursday, and the market's not allowed to be closed Thursday, Friday, Saturday, Sunday. So they have to have the market be open for on Friday, at least for a little while. So they do a half day. So you'll never see, unless there's an emergency like a 9/11. I know the market was closed for, someone needs to remind me exactly how long, but I think 2 or 3 weeks or something like that before it was able to reopen. But generally speaking, in the normal course of action, the market will never be closed for more than 3 days at a time. From Dave, if we make all-time highs in the Qs and SPY, but tariffs resume after 90 days, do we spike back down as hard as the first time, or does the market become jaded to the news? Well, I'm pretty sure. So I'm pretty sure that we are not going to be seeing any of the numbers from a tariff perspective that we saw on Donald Trump's big piece of paper that he brought out on Liberation Day. I'm pretty sure that that's definitely not happening. Everything is going to be reduced from those numbers. Those numbers were all starting negotiation points that were high and unrealistic. It's not going to be there. So I don't know. I mean, maybe you're right. I don't know. Maybe you're right. Maybe after 90 days, if he doesn't get a deal done with Lesotho's, they just go back to a 80% tariff on them or whatever it was. I say Lesotho's on purpose because I think that they are one of the highest tariff countries of any country out there that we picked. But I don't know. I'd be very surprised if I mean, look, it's not easy to get trade deals done, right? It takes a lot of time, and you're talking about every country in the world, and obviously we're putting the most important trade partners first. So, what are we going to do with a Lesothos if we haven't had time to speak to them yet to create an actual deal after those 90 days? We either extend the pause, or we put the massive tariffs that we have on them. I would assume that we extend the pause, but we'll see. It's I think at this point it's more going to be about the implications and the economic numbers of what these tariffs look like, because they are still pretty high. Like the number that we have on China as an example. I think the effective rate is in the low 40%. Someone fact check me on that number. But that's like still a very high tariff number. It's significantly higher than we were before. So there will still be an impact related to that on growth and on inflation. And, we just need to see what those numbers look like over the course of this summer. I think that I think it is possible still for us to see a retest of April lows at some point this summer. But that happens in a very different way. It happens because of a cyclical bear market, not a event-driven bear market, I think. And I posted in the VTF early this morning a note from Goldman Sachs. I posted it page by page in the VTF. Definitely read it. It was an update on what we had been talking about like a month or so ago. I don't remember, a couple weeks ago, where off of Pat's note, there was a Goldman note that was talking about these three different types of bear markets, right? Event-driven, cyclical, and structural. And that note just gives an update based on where we're at with the trade deals on, what Goldman Sachs expectations are, reduced probability of a recession now because of some of the deals that we've gotten done, but still the potential of damage. And it sounds like, generally speaking, a lot of those analysts don't like this market for continued upside here. Not necessarily calling for, a retest of April lows, like I just said, but don't really like the market necessarily for continued upside. And then you could also look at, which was in Pat's note today, the Stevie Cohen commentary that came out, which is what he kind of also seems to see of, a market decline, but not necessarily like a huge bear market or depression. We go sideways for a while, and that can actually be perfectly normal, which it can be. I think China is still in a position to walk away from a deal, and that's a very real probability. So my opinion on China, and I wouldn't call myself a China expert, but I feel like I know a lot more than most do. I think that they want to get a deal done. I think the United States wants to get a deal done. I think China wants to get a deal done because it's mutually assured self-destruction if we're at 145% tariffs, right? So yeah, I think everybody wants to get a deal done, but I don't think that China is just going to agree to every single demand that the United States makes. But I also think that the United States is smart enough to know that, right? And I also think that the United States knows that they can't have the 145% tariffs on them. I think it was a real wake-up call to the administration when they met with executives from companies like Walmart and said, "Hey guys, if we don't do something about a pause here with China or something, there's going to be no goods on the shelves come the holiday season." And I think that was a wake up call. Um, so I think China wants to get a deal done. I said it from the beginning. Um, what China wants more than anything, they just want to make money. I was saying that when Russia invaded Ukraine, and there was a lot of chatter on like China using that as an opportunity to have that be a jump off against Taiwan, or China stepping in as a Russian ally in the war or something like that. I was like China doesn't want to upset the United States. They don't want to upset Russia. They want to just trade with everybody that's one trade that's going to make them more money. And I still think that that's the case. So I think they want to get a deal done because they want to make money. The United States should want to get a deal done because they want to make money. And at the same time, I don't think that China is just going to agree to anything that is asked from them because they want a good deal done, and that's pretty much it. So over in the YouTube, a perfect scenario for short would be a grind tomorrow and a gap fade on Monday. Yeah, I kind of thought this morning. So the commentary from GBS in YouTube is an astute one. I'll reread it. I think a perfect scenario for a short play would be a grind tomorrow and then a gap fade on Monday. I kind of thought we might be getting that today. When we gapped down, especially we were down decently. I woke up at the perfect time this morning. I got really lucky. I logged into my computer at 5 o'clock and I started covering shorts by 5:10. I literally covered. I covered at the low on SPXL, TQQQ, Nvidia, Micron, Tesla, everything that I'm short. I covered a good amount of stock at the absolute pre-market lows by complete luck. It just when I woke up, I didn't wake up to an alarm. It just happened to be when the low came in. But at that time, when I was looking at this, I was like, yeah, you better believe I'm following my game plan and I'm covering some of my shorts that I'm supposed to cover here. This is great. But I was also like, wouldn't this be so classic if yesterday, as you remember, everybody's pulling their hair out because they're like, oh my God, this market never goes down. This never ending bid is just holding us up in every circumstance. And then we just gap down and we never give people the opportunity to be able to put those shorts on and they're having to chase lower if they want to be able to get any stock. It would be so classic. And then, of course, the never-ending bid returned, starting pre-market throughout the entirety of the trading session, more or less. And we made new highs of the month today. But yeah, that's definitely a scenario that could play out that way. Right. Anybody else have anything for today? Otherwise, I will wrap it up. I got a couple things to do. All right. Have a good night, everybody. See you tomorrow.